Investing can seem intimidating and complex, especially if you're new to the world of finance. There are so many different investments, and you may not know exactly how to create an investment strategy. If this feels like you are in the right place. One approach that has gained popularity because it's simple and highly effective in the long term, it's called dollar cost averaging. Today, I'm going to dive into dollar cost averaging, explain how it works, what are its advantages, and be sure to stick around until the end because I'm going to give you a step-by-step guide so that you can start dollar cost averaging with confidence. But first, if you want to learn how to successfully grow your money through investing, you should check out our free masterclass, Maximize Your Money with our 4-part intentional investing system and avoid common investing mistakes. I'll link to that in the description. Also, if you want more content like this, please subscribe and hit that notification bell. It is an easy way to support us so that we can continue making free financial education videos for you every single week. So what exactly is dollar cost averaging? Dollar cost averaging is an investment strategy that involves consistently investing in the market at regular intervals, regardless of what the stock prices currently are. So basically, you are deciding on a fixed amount of money that you're going to invest at a pre-established interval. This is kind of like if you have a 401k set up at work, and every 2 weeks when you get paid, the same amount goes into your 401k account. You're not watching what the stock prices are or what the market is doing, you're just always buying every 2 weeks. So sometimes you might buy when the prices are high, which means you get less shares, but sometimes you might be buying when the prices are low, meaning stocks are on sale, you get to buy more of them. So maybe you decide that you're going to invest $500 every month. This doesn't just have to be in your retirement account, this can just be for regular investing. So dollar cost averaging is a great long-term investment strategy. So I'll explain exactly how to do dollar cost averaging in a minute, but first I want to explain what some of the advantages are of dollar cost averaging. First is it mitigates market timing risk. So in trying to time the market is a very big investing mistake, and very few, if any, people are able to time the market well enough to gain any kind of financial advantage. Dollar cost averaging removes the need to predict the right time to enter into the market. So whether the market is high or low, you continue to invest and you're avoiding the emotional roller coaster of trying to time the market. Dollar cost averaging also creates consistency and discipline. It instills discipline in your investment approach. So by committing to regular investments, you develop a steady, long-term mindset that can lead to more significant wealth accumulation over time. It reduces volatility impact. So since you buy more shares when prices are low and fewer when prices are high, dollar cost averaging actually smooths out the market volatility and also helps you to manage risk. It also lowers stress. Dollar cost averaging can lead to lower stress levels. So instead of worrying about daily market movements, you simply stick to your predicted investment schedule. And it crushes analysis paralysis. Many potential investors suffer from analysis paralysis, never even starting to invest because they're unsure of when to jump in. This strategy overcomes this by making the start as simple as just choosing the amount to invest and sticking to your schedule. So really quick, if you're liking this video, please give it a thumbs up. It's an easy way to support us so that we can keep on creating free content for you. Okay, step by step, this is how to do dollar cost averaging. First, choose your investment strategy. Start by selecting the asset that you wish to invest in. It could be a stock, a mutual fund, or an exchange-traded fund known as ETFs. If you want to learn more about what ETFs are and how they work, why they make a great investment, we have a video on that and I'll link to that in the description. Number 2, decide how often you'll invest. A lot of people time this to when they get paid. So you could choose to invest every couple weeks, maybe once a month, or even once a quarter. Either way, choose your strategy and stick with it. Number 3 is set your investment amount. Determine how much money you can comfortably invest regularly. this should be an amount that's not going to strain your finances. So let's say, for example, that you make $6,000 a month, and half of that, $3,000, goes to your necessary expenses like groceries, mortgage, utilities, etc. Of the remaining $3,000, maybe $1,000 is spent on fun stuff like going out to dinner or visiting a museum. Now you've got $2,000 left, and if you're in a good place financially, one option would be that you could put $1,000 in investments and maybe $1,000 into a high yield savings account where it's still growing for you, but it's also really accessible. So just be able to look at where you are financially and then decide on the best amount for you because you want to stick to it. Okay, number 4 is open an account. If you don't already have one, open up an investment account with a brokerage or financial institution. If you need help picking a brokerage, we have a full video analyzing some of the most popular brokerages, which we'll link in the description. Number 5 is automate your investments. Many brokerage platforms offer investment plans that allow you to set up recurring transactions. So you can do that, every couple weeks or every couple months and just set it and forget it. So it reduces the risk that you're going to forget to make that contribution. And then number 6 is monitor and adjust. So while the essence of dollar cost averaging is consistency, you should occasionally review all of your investments and make adjustments if you need to make sure that you're hitting your financial goals. So some examples would be maybe increasing the amount that you're investing whenever you get a raise, or splitting your contributions between savings and retirement if you have certain things that you're looking to buy soon. So to sum it all up, dollar cost averaging is a really simple but powerful investment strategy that allows you to build wealth steadily and manage market volatility effectively. By committing to regular investments regardless of market conditions, you can reduce your risk, increase your discipline, and let go of some of that emotional stress with market fluctuations. So whether you're saving up for retirement or building a nest egg, dollar cost averaging is a great tool to have in your toolkit, helping you to reach those financial goals over the long term. Like I mentioned before, if you want to learn more about investing and building wealth, we have a wonderful masterclass with our system, and I will link to that in the description below as well. All right, thanks so much for watching. Take care.